Hi, everyone. So 2 weeks have passed. Sadly, nothing has changed. ES is basically at the same level where it was during our last market talk, but maybe we are closer to the overall top, or maybe top is there, or maybe not. So that's what we will discuss today. Interesting days in the markets. Let's start. So, Bryan, hi, what you see in the markets and what are you trading?
Hey, yep, good to see y'all. Let me share my screen here and we'll get right into it as usual. So in general, I've been trying to short stocks for about 2 to 3 weeks or so. I starting to try to aggressively short stocks starting May 1st and like that Friday before, so the end of April. If you remember the last meeting, we were talking about whether or not VIX was going to go, and I was talking about how there was going to be kind of one more VIX crush is what I was thinking here. And we got that VIX crush. So 2 weeks ago was April 26th. We were up over here at VIX 18s, just kind of like how we were most recently again. And we got the 2-day VIX crush. Both sector correlations as well as stock bond correlations were soft at that point. And so I thought that they would squeeze it into month end, which is what happened according to plan. And then I started shorting aggressively that Friday as well as that Monday. And so shorting as well as buying a lot of puts. I've been buying probably the most amount of puts I ever have right now. And the reason why is you look at things like specifically tech oriented. By the metrics that I use, like vol is just so cheap right now. And obviously you can look at that with just the VIX, but QQQ IV rank, for example, today closed at 2.6. May 1st, it was in like the 6%. And what that means is looking over the past year, 0 being the cheapest IV has been, 100 being the most expensive IV has been. So we're pretty much sitting right at the cheapest vols for the entire bear market. I'm not even looking at the entire bear market, just the last year. So pretty much just like the year of chop we've been in. Vol is the cheapest it's been, which I guess makes sense because puts haven't paid over the past year if we're looking to last May right now. So it actually makes a lot of sense that they're there. I don't think that continues, but SPY 4%. I started adding Apple puts. So after their earnings report recently, so Apple 0%, Microsoft, that one was at 0% as well. And so I'm adding puts on all of these things that are highly correlated to the S&P that show their cheapest implied volatility for the past year. So I'm no options guru or expert, but that seems like a pretty good deal to me. So that's what I'm doing. So I like adding puts and then shorting a little bit of less stock because obviously puts are a little more volatile than stock. But yeah, so we got the VIX crush, and then once I started shorting, it actually started working pretty well here recently in May, and then shorts actually were working. So we had 4 days in a row, the first 4 days of May. Stocks got hit pretty hard. It was working pretty well for the P&L, and I dropped the ball a little bit at last NFP. So just like the trap into the end of April, into that NFP report on Friday, we had sector correlations were still broadly strong. They softened a little bit, but stock bond correlations were still negative. And I had my target net exposure model flipping towards the positive side. And so basically all the signals were there that I was talking about last week for a squeeze, but I thought differently. And so I didn't cover as aggressively as I should have on Friday. And so that led to a pretty big squeeze that we saw last Friday, which sucked. And then now we're kind of dealing with the repercussions of that. And so some of the big signals that I had that were getting me short through here was the downside trend skew on SPY. The long-term range has been consistently falling, but it's not capped yet. A lot of individual names like Meta, Chipotle, a bunch of names under the hood have really weak long-term ranges that actually cap to the upside. And so I like trend skews a lot. And that's mirrored here with my trend skew models with my target net exposure model. So it's saying like from a trend and range perspective, from all the tickers I load from MFR, it's a pretty good risk reward to be short right now. Also, most recently, we've been seeing sector correlations get rather aggressive. And so actually the entirety of this week, they've been at extremes. They backed off a little bit today, but 0.83 is still very strong. And so that tells me that big moves are coming. And we're certainly seeing that this week, as opposed to April. These are some of the larger moves we've seen recently. So it's not really going anywhere. Obviously, the market hasn't broken one direction or another here in May, but it's certainly the setup is there for a big move. And so I'm hoping that's to the downside. And so this week into today, into the CPI report, I didn't have stock bond correlations starting to go yet. They were deeply negative. That was a signal. I don't know. It could have, again, I wasn't sure into the CPI report today. I guess it was a signal that we'd get that rip on the open, but the fact that equity sector correlations are still so strong and risk reward is good for shorts and vol is so cheap, I wasn't surprised to see that sell from the open down into 410. And then obviously we got a rip right back into the close today. And so the good news though, is that today stock bond correlations improved a lot, as well as SPY UUP improved a lot. And so these are updated as of the close. And so dollar is actually inversely correlated to stocks right now. So if we get a downside move in equities, I would expect to see an upside move in the dollar, which would be very positive. If you look at UUP, it's gone nowhere for, 2 months now, 3 months now, 4 months now, the entire year, it's gone nowhere. So, but if you look at the ranges, the trend skew is still good from a long-term range perspective. And it's starting to improve a little bit. It flirted with neutral trend, I think, yesterday. Will probably stay bearish today. Implied vol and realized vol are so low. So it's not a horrible place to be long the dollar. And so I'm still aggressively long the dollar. And to actually lever that bet, I'm super short gold as well, which has not been good. I think when I got short at the long-term range was favorable. Now it isn't. And I know that. I know it's a really horrible, there's really nothing right now that tells me to be short gold. And so, that could be you calling me a perma and whatnot. But the fact of the matter is, like, the way that correlations are working right now, gold has been super inversely correlated to stocks at appropriate times. But right now that correlation is getting a little extreme. And what you saw today was gold wasn't catching a risk off bid at all. It actually started uncorrelating from stocks today, which was a good sign. And gold also closed red on the softest CPI report for the entire bear market. So that also tells me something. And so I'm short gold, one, because of its inverse correlation to the dollar, which should stick. That one actually has recently gone positive in the short term. So that should revert negative here in the near term. So if stocks go down, dollar should go up. I would expect gold to no longer catch the risk off bid. And there's always the big downside in gold kind of looming out there, that when we get a big volatility event, people will sell gold and as a means for getting liquidity. So I think there's like an option on gold just absolutely puking on a down stock day, and everyone's bullish gold. So I don't mind staying short here, even though nothing from a trend following perspective has told me to do that. I'm okay getting squeezed on it and being long the dollar with it. It's actually worked out well being short equities. It's hedged me on days like on Friday, for example, where stocks ripped and gold got hit hard today, and it worked well today as well. So I think it's a good counteracting thing, but as an outright short, I wouldn't recommend it to my greatest enemy. From a gamma perspective, these are a little skewed into the close just because of how we closed, but the big level right now is 410. It's absolute gamma as well as gamma flip. We flirted with it today. Looked very hopeful. Everyone thought we were going to crash. I started sending memes out that we were going to crash. And I knew it was possible we bounce. If we look here, like the short-term signals that I use from Raphael, from a short-term perspective, like this one's really good for day trading. It was oversold here into 410. So the bounce was likely, but man, they really took hold of it today and just absolutely crushed vol. So like absolute gamma, which is 410, I look at that as like the vol crushing level. So if you're above absolute gamma, you're more likely to get vol crushed. That's what kind of led me to call the squeeze over in April. And then if you're below absolute gamma, vol is likely to hold a bid. And so there's potential for it to hold a bid, but as soon as they got up that, they just really went with it. So there's that. Basically, we need to go down and break 410 now in order for shorts to work. That's critical. Otherwise, you do risk more vol crushing. But vol is so cheap right now that it could bottom any day. So I'm less concerned with the vol crushing. Like, so into today, you had IV ranks at 10%. So they bid implied vol up to only a 10% IV rank into today. So a vol crush was possible, but they're just going to crush vol like they did back down to the cycle lows for the bear market. So it's less, it's less like in March when implied vol ranks were up towards 40 and 50%. Then when they crush vol, it's more of a sustainable trend. Right now, it's just like a one-day chop to crush vol. So it's okay to wear it. That's why I'm not too worried about holding on to shorts through a day like today, because I don't think this trends higher. Another thing that tells me it's not going to trend higher is Hurst exponents. They're just so soft right now. For 0.46, like looking at an aggregate, 0.67 on SPY, they're really soft. So that's not good for bears, and it's not good for bulls either. And it just encompasses the chop we've seen. So it's kind of a non-signal, but it is a signal that we're less likely to continue higher, especially considering trends are rather favorable. So that was a lot of rambling. In general, I'm pretty bearish right now. I'm pretty short as well. You guys, I do my little confidence score on Twitter. It's at an 80% confidence of downside. What would get me 100% confidence for a puke? If we break 410 on stock bond correlations going positive. If that happens, pretty much everything will be telling me that markets will puke. So I hope that happens. I could see it happening tomorrow. And Raphael will talk about how he thinks today is the VIX bottom. So that'd be great. But I think the setup is there for a pretty big puke. And so I'm shorting stocks. I'm getting the signals to short stocks. You look at my top 175 here, anything below a 0.3 is a short. There's lots of shorts out there. High beta, low beta, staples, you name it. I think it all goes down together. Gold, bonds, super TLTs breaking down like a dog. And so, yeah, I mean, like everything's there to short besides stock bond correlations, and us really breaking down. So I'm short, and I'm holding short. The things that would get me to cover and change my mind is correlation softening aggressively, trend skews somehow really shifting higher, but it's hard for that to really happen also, because you have like S&P, Qs, all the big tech are bullish trend. Some of them are already capped to the upside, like Microsoft and Meta. And so I think this market's going down, and I think it's okay to short and hold now. I didn't say in March, I was clearly saying it's not time to short and hold. Right now, I think it's okay to short and hold. And I like buying puts and holding too for September and June is what I'm going for. So on those. So that's where I'm at. Hopefully y'all back me up.
Yeah, I hope that happens tomorrow too. We'll see. Okay, Ted, what's on your mind?
What is on my mind? Lots on my mind today. Let me share my screen as well. I can tell you that I'm still pretty much where I was last time. I'm being really tactical on small trades and basically scalping, not quite daily, but that's essentially what I'm doing. So let me share my screen and kind of walk through my process. Let's see if we can get this right. All right. All right, I'm going to just touch briefly on the macro regime. I don't think it's changed much. Touch on some signals that I've been looking at, and then walk through positioning and share some trades that I've been working through. So macro regime, shared this last time. I think, the trend is clearly down for the economy. Manufacturing's rolled. Services are sort of still hanging in there, but, starting to soften around the edges. No real change, no real big data prints that changed my perspective on that in terms of where growth is headed, which is lower. This came out Monday. Fed had it for Fed Day. I borrowed this from Jeff Snyder's $0 University, but this basically shows you that on balance, banks widely reported expecting to tighten their lending standards over the rest of the year. That's both for commercial, real estate, as well as individual. So, not only do we have a ostensibly tight Fed, we've got bankers that are now starting to tighten around the edges, and they reported that loan demand is starting to soften as well. So this is not a good omen for the months ahead in terms of where the growth regime is headed. I shared this last time. Fed officials think we're headed into well, they call it 0.4% growth, but it's still negative. We had CPI today, got a 4.9% year-over-year print. That was really driven higher by owner equivalent rent, which came in just under 8, I want to say. I haven't had time to, today's been a busy day. I haven't had the time to dig into that report, but, basically we still have, since last June and the base effects comparing against that, we're still going to see some decline in inflation. So, you'd think, hey, get your deflation playbook out. Maybe bonds would start working. Bonds aren't working. So it's definitely a confusing regime. I'd still call it deflation in my book, and that's sort of where I'm leaning, which is generally short equity, short commodities, short long, looking to get long bonds, but not finding them in an opportunity, a good place to do so, but for one exception. We've got the Fed. This is an opportunity, I think. The Fed continues to tighten. We've still got this deep inversion in the 10-month, 3-year, 10-year, 3-month rather. And what I'm anticipating is that as soon as we start to cut rates, which that's my next slide, we're going to get a pretty radical steepening in this curve. And I think there is an opportunity to get long steepeners here. This is basically rate expectations. What you'll see is that starting in July, we have a consensus building for quarter point cuts, and quarter point cuts headed all the way through to the end of the year, such that we've reduced interest rates by 75 basis points. What happens to the long end really doesn't matter. If it just stays where it is, and short rates start to come down, Fed funds rates start to come down, we're going to see that steepener work. So that's an interesting question for me. I want to know what everybody's seeing. The Fed is telling us we're holding rates. We're not cutting rates. So something's happening. Something's brewing beneath the surface here, to Bryan's point, that I think we're going to have an event, and vol will probably pay over the next 2 months. I listened to an interview. You guys probably caught it too. It was Stan Druckenmiller presenting to the USC graduating MBA class this past weekend. And he said, this thing is so complicated, I just want to stay alive financially until the chaos comes, because it's coming. And so I'm in that camp. I've been in that camp. And so my current approach is basically to have a significant allocation of bills earning 5%. I can afford to be patient. I'm going to be patient. I've got core positions that are both longs and shorts, but they're small size. Obviously, if I've got a big cash position, I'm taking tactical, doing some tactical trading of ranges, and I'm taking profits quickly. So just in terms of some things I'm looking at, what I'm trying to do with the small amount of money I'm playing with is I'm trying to basically be long those tickers that are showing bullish characteristics over various time frames, from 15 days, which is 3 weeks, just to reference this trading days, 15 days, 20 days, 55 days, and 60 days. So I'm looking at things that are basically, I want to be long things that have more green than they do red. UUP, which is the dollar index, is basically neutral. I don't really want much to do with that at this point in time. Bonds are doing nothing. BNDX, sort of your classic recessions play, like a low volatility, doing nothing, getting a little bit of action out of tips, but not much. And of course, SPYG, which is, long, big cap growth, continues to show some strength, but softening in the shorter periods. Bryan said bonds doing nothing, totally doing nothing. What I am looking at is shorting high beta. I'm also looking at the BB happens to be a Vanguard ticker for IWM small cap. So I've been playing with that a little bit as a short opportunity. Then looking at sort of the sectors, there's not a lot that I want to be long. I guess I would get long staples. I'm not long staples. On a pullback, I'm always going to be playing pullbacks. I'm not going to be buying at the top, or at least I don't think so, or I'm getting out. And basically retail and metals are performing really terribly, as is energy, just continues to break down. We can't get any bid in either the commodity or the sector. So in terms of active trades, like I said, one of the things that I want to do is I want to get long things that are bullish and sort of uncorrelated with SPX, which would be, this happens to be DBA. I've been in and out of this over the course of 3 years. I missed this entire move here, but I did see DBA break back the bullish trend. I started to buy here on a pullback of one standard deviation pullback, bought, sold a little bit, and have not added back in, but we did have a strong day today. I think it closed around 2106, 2107. So I had a bigger position. Now it's a smaller position because I took some profits, but I'm going to let that run and probably take it off as I get to the top end of that range. IVOL is the steepener play that I'm using, which is Nancy Davis's fund. Saw that one break out, used this as an opportunity to buy some here, sold some in the middle of the range, bought some more here when it pulled back, sold some more here. I was looking to add to this as it came back to the middle of the range, and it didn't give me an opportunity. I think it broke higher today on today's move. I looked earlier, it was up like 2%. So I've not been able to add to that position, but it's one that I want to be able to add to. On RWM, which is IWM short, that is like the equity that is, or the sector, not the sector. It's the index that is definitely a short in my book. It's bearish trend across all time frames. So I've been really kind of not quite day trading. I'll buy at the low, and I've got a lot of chop here. I bought, I sold, I bought, I sold, I bought some. I almost bought some more today when it went kind of opened higher. I didn't. So I do still have an open position here. Didn't close it. Was hoping to add to it. Didn't get it. GDX. It's not behaving well, to Brian's point. I have a small position in GDX. I added that around the end of April on a pullback here. I should have sold some here, but the way this thing was acting on that day, it looked like it was going to take out that 3610 level and maybe go. I mean, there's a lot of gold bulls out there, and at some point they're going to rip on this thing, but it didn't go, and it's not behaving well. I probably don't want to hang on to this too long. Let's see, what else do I have for you? Oh, okay, so this is a weekly chart. What I was showing you before were daily charts, and as you guys know, I kind of look at the weekly. I look at it on Thursday, Friday to see if there are any opportunities. I'm really looking for something that has been deeply oversold. This happens to be FXY, which is the long yen. It had gone, basically this is the Williams %R indicator that I use. It had gone deeply negative. It was trading down at the low end of its range. We got a big volume spike last week and a nice little candle here. So my strategy is take a position, even whatever it is, just take a position. So I took a position on Friday with that. It ended up being, I bought at this candle. You can see the volume spike there. It was actually a sell day, a negative day. It based over the last 2 days, and today we got a nice move up. This does not always work, but I want to get, so generally I'm buying trends, positive trends or selling bears, but in this instance, I had an opportunity to take advantage of this weekly oversold condition and try to get into a position, because sometimes this will run. So that's basically what some of the things that I've been active with. I'll leave this up on the screen, but I've got 84% bills, DBA, some FXY, some of the things that I mentioned last time. I was holding on to this EWW. There was no reason to sell it, but I didn't have much of a position in it, and it ripped today. So it's haven't had an opportunity. It hasn't pulled back at all. It's just something that's just kind of keeps on trucking. That's long Mexico basically. IVOL, small position, want a bigger position there. I'm short high yield. I still have my CTA position, which is negatively or positively correlated with the dollar and negatively correlated with everything else. So that's basically what I'm looking at.
Interesting. Thank you, Ted. So, Robby, you are also bearish or not?
Yes, I'm also bearish. With a couple caveats. Last week or 2 weeks ago, I showed a chart about liquidity internally in the S&P 500, and I'll just show that updated chart again. So 2 weeks ago when I shared this chart, I highlighted the orange dots, which showed extreme illiquidity internally in the S&P 500 with very little price change. And that was abnormal because normally when there is such high illiquidity, you should see a lot of variability in price movements. The past 2 weeks were effectively no different, except we got a little bit more variability, but equally as illiquid. Those are highlighted by the red dots here. And then the past day, or May 9th, is this purple guy. So the 10-day average of this 50-period liquidity rank was the highest it's been over the past month. And there's only a couple instances where it's been on a 50-day rank basis higher. And these guys are all from March 2020. A couple challenging things that if you're bearish and you want to buy volatility is that the level of volatility is quite low, but the level of contango is quite high. So it's a little bit challenging in that sense because it's over the past couple of years, it's been the absolute worst time to try to capture carry in the volatility space. But at the same time, if we do nothing, then the volatility positions will bleed quite a bit. I have a couple other charts I wanted to share about one to just go off of Bryan's talking about correlation. So Bryan mentioned in the past week, short-term correlations have increased. That's also what I've seen. Despite us going nowhere, essentially short-term correlations are printing about 0.7 on a 10-day basis and 0.6 on a 20-day basis. The intermediate term is still pretty neutral overall, and the longer term is at the higher end. So that's another thing that's getting me bearish. Lastly, I was talking about contango. So this is a chart that looks at two variables. The first on the left is contango as measured by the volatility index to the 3-month volatility index, so VIX to VXV. And then here on the bottom, I've got the spread between implied volatility and realized volatility. So as of today or yesterday, we're about 3 points on the spread between implied and realized volatility. So that's not particularly wide by any means. And we're at a level of about 0.82, 0.83 of contango. So that's pretty wide on a contango basis. In March and in the past couple weeks where we've bottomed, we kind of spike up on a realized to implied basis to around 8 to 11 points. The March low was 11 points. I think we got to 8 points on the last bottom last week and about 9 points the week before that. This blue color is highlighting very positive returns on the SPY, and the red color is highlighting very negative returns on the SPY. So whenever we spike the spread between implied and realized volatility, we're basically putting a brake on the index. If we really want to go down, this spread is going to have to go negative, and we're going to have to backwardate. That's really what, and by the time we get there, volatility will already have had a big move. But instead of an event like March was, where we spiked up to 11 points or a bit higher even, if we backwardate and the implied volatility spread with realized volatility goes negative, it's less likely it's an event and more likely it's something more sustainable. And again, I don't know if that's going to happen, but there seems to be quite a few things aligning despite us over the past month really not moving anywhere at all. So I hope that helps provide some context of what I'm looking at today.
Sure, very interesting. Thank you very much. So, Raphael, how is it going?
Hey guys. Yeah, so a lot of things people said I agree with. Like you said, we have gone nowhere for the past 2 weeks. So I'm going to go through what I'm looking at. Okay. So what we've witnessed so far is volatility of US indexes getting crushed. I mean, you can see here, this is in blue, the volatility of US 500. It's basically going lower and lower as we move forward in time. The index has been a bullish trend with some chop since November of last year. So for now, no change in sight. Although these past several weeks, I have witnessed some stuff that are quite interesting, in my opinion. So what I look at to take big positions on the short side is when vol itself is really crushed to the low. So in blue here, you can see this is the volatility of the US 500 that I measure. It's a synthetic way I do, and I have a minimum I'm looking for this volatility to go to take a short position with confidence, or at least increase an existing short position with confidence. And volatility of US 500 reached this level 2 times actually since the past month. We had one on the 18th of April. And another time was actually at the beginning of this month, on the 1st of May. You can see, for instance, what happened it happened the last time on the 2nd of February 23, so which was a celebration day for Bryan. So we already had two times this kind of event since mid of April, and now the question is if we're gonna get another one, or if vol is finally gonna spike. So I will show you some other charts, but I'm thinking that volatility is finally getting off its ass. Then I'm gonna go to Nasdaq. So pretty much the same kind of look as the US 500. You get the volatility crush. It's been happening for some time now. And we had 2 prints of minimum of vola. One was the 1st of May also. And we had another one also very recently on the 8th and 9th of May. So these 2 dates were pretty good time to either buy add to shorts, or also, and can be end, buy more puts if you are buying collecting puts for so Nasdaq or SPY that I mentioned before. So QQQ and SPY basically. So you can see volatility is crushed, and we've reached minimum 2 times. This is not something that you will see every day. So this kind of price action, this kind of action on volatility usually precede a big move up for volatility. I'm going to go through some other stuff. So dollar has been addressed before, and I agree with everything that was said. So you can see here, volatility has gone nowhere. on DXY. And I also noticed that for I would say at least a few months, 101 has served as a good I would say resistance for DXY. Anytime DXY has gone to 101, it's been beat up. So I have no idea why, but if you day trade, for example, like I do Euro USD, it's a good thing to know that 101 is a good resistance for DXY, and you can trade either UUP, either Euro USD, or any currency that you like that is dependent on the DXY ticker. But for now, yeah, volatility is going nowhere. Usually when I used to see volatility above trend and above trade, you usually got a spike in vol and of course the price of the asset going down. But strangely, since mid-March, it's gone nowhere, right? Volatility is just stuck at trade and doing nothing. So at some point in the future, of course, I expect volatility to go one way or the other. My expectation would be to see volatility actually go down, and DXY will claim a trend, a bullish trend, and finally to get out of this, you can call it a range, and finally move up. Now for Euro USD, you can see the same volatility has been crushed. We are currently approaching the minimum I'm watching for the trade of volatility of Euro USD. So I have explained this way of monitoring volatility a few times before. So I mark some level that has been reached by the trade of volatility of an asset in the past. It's basically where the trade of volatility will go before we get a spike in volatility and then a crash in the underlying asset. And this level has proven very useful in the past for Euro USD, and you can see here that we are approaching this level. We are not there yet. Another asset that I'm monitoring also is gold, and it's having the same kind of action in terms of vol. The mean is marked there, so it's at 2. And you can see the last time it happened, but it happened before. Anytime trade of the volatility of gold went there, and we are not there yet. I know Bryan is watching gold extensively for it to go down. I think we are not there yet, but we are really approaching it. And so you can see Euro USD, gold, those assets have a high correlation to dollar. So maybe when we get there, this is finally when we get the move on the dollar. Now I'm gonna go with the big one, the VIX. So I have also addressed this many times before. At the moment when volatility will spike is always, at least in this bear market, when the trade of volatility of VIX reaches the trend of volatility of VIX. So you can see here the white line reaching the green or red line. So we had this event here, 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 and now we are approaching the same setup. So my guess is we will finally get a move in vol in the next 1 to 2 weeks. I am also watching, of course, on the 1 hour, and that's why I told Bryan and the guys that I believe today may be a bottom in VIX. Is that I'm starting to see trade actually going down. So I would like to see trade go below the price before being absolutely sure about it. But the trade of volatility of VIX is actually pretty high. Volatility of VIX is also pretty high. It reached some of my triggers already for volatility of VIX to get crushed and then volatility to rip. So you have a lot of confluence currently happening in terms of signal. So you have the daily volatility of VIX reaching the trigger points. You have had several events on US 500 and NASDAQ with volatility reaching minimum. You have EURUSD and gold approaching their volatility trade approaching their mean very soon. So I would guess that we would get very, very big confluence in the next few weeks. So in terms of my positioning, so I have tried to add at these particular points on shorts, and also I'm trying to prepare for the next vol event by buying puts. So I stuck with SPY currently. I didn't go with QQQ as some has chosen to do. But yeah, I'm accumulating puts on SPY for June and September expiration day. So I expect a big vol event to come in the next few weeks. If you have any other question later, maybe I can address some other points. But yeah, that's it for me.
Raph, I was just looking at that hourly VIX. It's like the highest level it's been since March, isn't it, on the hourly? And that was even like with like March when it was in the 20s, and then February. The most comparable one's probably December. It's really high, the hourly VIX compared to
it's quite high. I don't know if it's the highest it's been this year, because you have a point here. You can see it happened on March 23.
Yeah, but I guess that's different because that was like during a VIX spike, right?
Yeah. So what's interesting here is that versus what happened in the end of March is exactly like you said. This one was after a VIX spike. So here you didn't get the rip. You just had VIX just going nowhere until it was the volatility of VIX was crushed, to get then the next spike in volatility and then the next crush in VIX, right? But now this setup is happening with VIX at 1692. So of course, volatility of VIX going very high at VIX 20 something, and volatility of VIX going very high when VIX is at around 16 is absolutely not the same thing. So that's why I'm quite confident that the bottom may be in for VIX. And I would expect a basing and then the rip to happen in the next few weeks.
Great.
I stop the share here. Okay. I'm good.
Yeah. So thanks, Raphael. Yeah, so you said you chose SPY, and actually I'm thinking that to add to my current positions, and my current positions are still very small, most likely I will choose QQQ instead of SPY, because what's going on with that thing, I mean, I already have SPY puts, I have a bit of ES, so if tomorrow the signal is the same, and I'm sure it will be the same, maybe I will buy QQQ puts, or if we get a wall spike in the morning, it means I missed puts, then maybe I will do something with QQQ outright. But yeah, not a lot of changes. So you guys already talked about the correlation. So yeah, correlations are relatively higher, especially short-term ones. When we are talking about 5 to 10 days, they are relatively high, and without stocks doing something at all, because funny fact is that our last market talk was on April 27th, I believe. So yes, it's basically at the same price today when it was compared to where it was on April 27. I believe now the difference is like 2 points. And of course, we had few interesting days. but overall nothing changed. I'm short 6E. Well, it's like 50 basis points in profit, but it doesn't move. So I'm not very happy because I expected faster and stronger move. But yeah, I'm holding because the signal, I use the futures 6E contract, and I use huge volume levels in basically in long-term volume profile, combined with signals from my fractal range to choose the entry spot. And I was looking at that level for a long time, and it was 1.1050. Yeah, so I'm still short 60. I have SPY puts and a bit of ES, but I plan to add QQQ. So for now, cash is 86%, and I will not show correlation charts or anything because you guys already talked about that. But yeah, that's the game plan. Nothing changed, still bearish. I think that I will add QQQ. And the good thing from MFR now, I'm looking at some numbers, are that my favorite macro spread, XLU, IWM, real-time numbers have great upside downside ratios for both longer term and regular term. So upside downside of 1.5. Also, what I really like is Apple numbers are weak. So it means by numbers, I mean signals. So upside downside ratios are way below 1. So I'm watching what's going on with Microsoft. So because of those signals, Apple, Microsoft, and overall volatility that Bryan and you guys already talked about, yeah, I think that I will choose QQQ, and maybe as soon as tomorrow. If I do, I will tweet about that, of course. But yeah, those 2 weeks, my portfolio has not changed. I was basically scalping ES sometimes, but basically that's all I did because I still had no convictions to hold for positions for longer or to hold something bigger overnight, except those positions that I already have in a for swing trade. So yeah, and for now we saw what happened. So I think it was a good idea that I was not holding anything overnight. But yeah, my advice is monitor now overall volatility, so what's going on with VIX and upside downside ratios. But because of relatively significant change in shorter term correlations without a significant change in ES, so SPY, you name it, so in the market, I think that move down is near, or maybe even we already had a top. I believe Bryan has this opinion as well. So I don't know. I never say things like 100%, but I think that conviction is high that move down is close. So hopefully that's what will happen, and hopefully I will have time tomorrow to add to my positions if everything remains the same, because worst thing that can happen, and especially for me with my conservative risk management, it happened quite a few times when tomorrow I will buy. I wake up and in the pre-market market is down like 3% and VIX is up like 25. Okay, so I missed puts. Okay, so yeah, but it happened. Hopefully it will not happen. But yeah, so for now, no changes. But good news is that everything looks like it's getting ready to go down. Yeah, so that's it from me today.
Yeah, bye. I want to add one more thing onto what you're saying. I'm gonna share my screen real quick. I quickly made a quick watch list in MFR, and these are some spreads I started tracking on a daily basis in MFR. Actually, UIWM obviously from you, and the other one is like high beta, low beta, value growth, and then Russell growth. And all of these kind of signal to me risk off. And the really interesting thing that's actually made me feel rather confident in May remain short is all of these spreads are great for bears. Like consistently high beta shown like a week longer term upside downside ratio. Value's been leading lower. Russell's been leading lower. Although I think eventually Q's catch up to this one. I made a chart about earlier, just Russell Q's is at like a all-time low at this point. But either way, like Russell leading lower is a signal of the poor breadth, is a signal of Apple supporting the entire market. This one's been good. And yeah, like you said, XLUIWM, that one just looks like a beast. I would actually put XLUIWM on if I wanted to spend the margin on that, but I'd rather just short a bunch of stocks at this point and buy puts. So I'd rather spend the money on that. But this looks great, and so that signals to me some risk off stuff. So just wanted to add that on.
Yeah, I absolutely agree, and it's great. I have 3 of those 4 spreads in my watch list. A good idea about IWD. I will add that just to monitor. I don't have that, but yeah, high beta, low beta, IWM, QQQ. Yeah, I'm monitoring those. And Hurst exponents are high, well, except the high beta, low beta. Okay, those are a bit choppier, but on other spreads, yeah, also. What is a good signal that Hurst exponents are relatively high. So yeah, also, yeah, but that's really important. IWM QQQ is crazy. Yeah, yes, totally agree. Okay, Raphael. So how is the situation on our YouTube? I guess
we have a few questions.
Awesome.
Okay, so Raghav is asking. VAI, when is time series of 5D, 10D, and 30D correlations coming to MFR?
Time series, yeah. So it's a very good question, and what can I say? It is coming, but this year, at least that's the goal in our head, in my head, and in our heads. That this year it's coming, but I cannot say exactly when. But yeah. Basically, spoiler alert. Of course, it's not finished, but the dashboard that I built and I was showing for the last couple of market talks is like my beta project of how I want MFR correlation page to look like. So once I'm finished with that, and we have a time on schedule, because of course we are working on our improvements and new things all the time. So of course it's not only correlation. So when we have time on schedule, and when I'm happy with the final, I'm sure that we will implement. So hopefully this year. But yeah, spoiler alert, but that dashboard, yeah, it's basically my beta version of how I want MFR correlation page to look like. So it's coming. Thanks for question.
Yeah, for those who have not seen the dashboard of VAI for correlation, it's pretty useful because you can check the correlation on the time frame you want. So it's been a regular request from MFR user to be able to have a dashboard much more flexible than the one we currently give, which is static. And the reason why it's not coming now is because we have some stuff on the pipe. So the first thing is we are redoing entirely the design. Second is we will open a demo type account. So basically you pay €1 for 3 weeks, you have full access. So people can discover the full stuff, because now a lot of people, they try free, but they don't know what's behind the paywall. So that's the second stuff. And the third thing we are working on, VAI is working very hard on this, is that we want to open the trend for the TradingView users. So we have also some other scripts that will be added, but at least the trend will be available for some of our MFR users. So that's what we are working on. Some more questions. So VAI again. How does VAI use the 1 year Hurst? I use the 3-month Hurst along with daily chart to determine direction of trend. But what time frame would you use the 1 year Hurst on?
Yeah, also good question, and not a surprise that Hurst exponent is coming up and up again in questions. So yeah, basically I tend to look into things fractally, and what it basically means is you monitor same things in a lot of different time frames to spot signals and similarities. And so first, how I use is to compare the conviction based on different amounts of data. So the usage in most cases is the same. I will give a second example a bit later how to use it differently. But basically, what I want to see is whether Hurst is high based not only on like 3 months of data, but also 1 year of data, and it gives me the same signal. So it means even if I'm looking shorter term or longer term, both signals are high, so it's good. So it means this asset is trending strongly. But I don't use periods that are used in academia. So in academia they use like 4 years and more. We are traders, so I'm not really interested in that. But basically, I don't use them separately. My first answer is that I don't use them separately. I use them in combination to see if the strength is only in the short term, or if that strength is based on longer time frame as well. Above 0.7 in 3 months and above 0.6 in 1 year is what I call high Hurst exponents. Again, from my experience using those. Again, academia would argue, because in academia they say above 0.5 is high. So, but guess what? When you take shorter time frames, almost all the time Hurst is above 0.5. So it doesn't make any sense. For me as a trader, not an investor, because so now if you are a trader, active trader, so you are trading either on a day trading or short-term swing trading, so you hold positions for a couple of days, a couple of weeks, 3 months Hurst is enough, and you can ignore that 1 year Hurst. But if you are an active investor, what I think that's the term, where you are not holding for 30 years or so, but you are actively managing, but you are holding for at least months. So cycle investing or active investing, so you can't ignore 1 year Hurst exponent, because if the trend is strong on 3 months, but is weak on a longer term basis, then you need to consider that information and act on it. And the third thing that I always repeat is that Hurst exponent, both 1 year, 3 month, doesn't matter, in combination, can tell you what strategies to use if you have a trading idea based on macro or any other reason. So you have an idea for an asset, the Hurst exponent can tell you what strategy is better to choose, or to just trade the range. So low Hurst assets, I just like to trade the chop. I mean, based on range, and you just buy it short term low end, and sell when it comes to high end. But based on regular range, not longer term, you just trade that chop. And for high Hurst assets, basically, I tend to more use longer term range. And if I buy based on signal, there's no point to sell like the same day or the next day, because those assets tend to trend. So maybe it makes sense to ride that trend, not to just go in and out. So I hope answers. But my advice is to use them both to check the confirmation. First, you watch 3 month Hurst if it's relatively high or no, and if it's relatively high, then also check the 1 year Hurst, because if you see that 3 month Hurst is above 0.7, but 1 year Hurst is below 0.6, so it means you can expect choppiness in the longer term. Yeah. So hope it answered the question.
Thank you, Vai. Quickly, before we address the last question and then we move to the bet, I forgot to mention when I was talking that something interesting happened in CAC, London Exchange, IBEX, and Euronext all of them move to neutral momentum on MFR. So something to pay attention to. Now for the last question, actually, I would like to have maybe Rob and Bryan to give their opinion about it. It's about correlation. So can you explain the rationale behind the correlations, basically why you use correlation? Also, why do extreme positive sector correlation to SPY and positive SPY long bond correlation mark a top? So it's not exactly that, but could you guys explain why you monitor correlation and why extreme matters? How do they play into risk, etc.?
Sure. Brian, I guess I'll start. The way I think about correlation is mostly as a risk management tool. So if you think about everyone on this call, myself, Raph, Vi, Ted, and Bryan, say we all buy $100 of SPY, and that's our entire portfolio. Our returns are going to be perfectly correlated. So whatever happens to Vi is going to happen to me. Whatever happens to Ted is going to happen to me. Whatever happens to Bryan, it's going to happen to me. We all have the same outcome every single day, as long as we hold that $100 of SPY. So when you think of sector correlations, it's the same idea. If you replace each of the sectors for just myself, Raph, Vi, Ted, and Bryan, and think about them trading in a perfectly linear fashion, then that just indicates that they have the same fate. So that's a perfect correlation. A low correlation is when the sectors, or say Raph, Vi, Ted, and Bryan, are all doing different things. Like Bryan buys $25 of gold and has $75 of cash. Ted has 100% cash. Vi has $50 of SPY and $50 of gold, and Raph has 100% TLT or something like that. In that kind of portfolio, everyone has a different outcome. So hopefully that's a good example of how I think about using correlations on the market to determine risk.
Sure, that's helpful. Yeah. So I look at it like from an instability perspective. If everything is going up or everything is going down, you're going to get a larger move at the index level because of that. Rather than if you're in a low correlated market, you're unlikely to get a trending move in one direction because you've got tech going one way and then you've got utilities and defensives going the other way, and that's going to support the broad indice. And so if you have equity sector correlations that are very high, you're more likely to get follow through at the index level, which will then promote volatility broadly across the sectors. So if everything is going down together, that means S&P is going to go down harder, which means it'll break through key volatility levels, which means people will buy puts on the S&P, which means the S&P will go down harder and all those sectors will go down harder. So it's something, and it works both ways. So if you have a really big up day, which we've had like on Friday, for example, sector correlations blew out because everything went up together to the upside. Well, that means that if everything stays correlated in that manner, that's very unstable. You get to drop very quickly to the downside, which is like what you had on the open today. So it promotes this idea of the broad index moving a lot more because everything is moving together in the same direction, which will get more volatility, and which is what we want for a significant down move. Then if you layer over bond bulls getting whacked at the same time, then you have the perspective of people that are long a 60-40 portfolio that are max long bonds and max long stocks. Their bonds aren't providing the same kind of hedge, and then they're in a situation where they're selling both their stocks and their bonds. And so that way, if stocks and bonds are correlated, that will promote even more instability to where they'll all go down harder. So that's the way I look at it. And so I look for correlations as a leading indicator for me of whether we can break through a key level. So for example, today the big level was 410. And so we had equity sector correlations very high. They've been high this whole week. And so that's allowed me to stay confidently short, even though we've been above 410, which is that vol crushing level, because I know that there's enough gusto behind the market to move it in that direction. Robby mentioned in his bit when he first spoke a few minutes or multiple minutes ago, 30, when he spoke in his initial deal, about how we have started to see a little more movement within that illiquidity. And you can see it. Today was probably one of the most volatile trading days for the past month, at least. And that's a good sign. That's a sign that everything is starting to correlate more. Right now, it's starting to correlate more at the sector correlation level. And that's a sign that we could get the gusto to break through something like 410, which has a lot of puts at that level. And if it breaks through fast enough and those puts don't close out, they go in the money and dealers have to sell and the market will break down. And then when the market's breaking down, you want to see correlations stay high, because that means that people are consistently selling into that down move across all their assets. Best case, bonds get whacked in that down move too. Better case, gold gets whacked in that down move too. And then where does the money go? It goes into the dollar. And so that's why we look at SPY UUP correlation. You want to see that money is flocking out of these other assets and going to the safest asset. That's not like a macro thing, just the safest asset of the US dollar. That's what was the case in all of the big pukes we saw last year. And so that's the kind of setup that you want to see through this move. Most recently, the March puke was very different. The March puke, we got sector correlations very high in that sell, but instead people ran for safety, not in the dollar, but they ran to bonds. And that then led to people thinking it's okay to buy NASDAQ and tech and defensive stocks. And that led to sector correlation softening. And that led to the BMR that we've been in since March. You see? So it's like, if we wanted March to continue, that's why as soon as the banking thing happened and I saw bonds bid, I was like, oh, that screws up everything since February, because now people think it's okay to buy bonds. And every time the stocks drop, that means that we bid up rate cuts. And it's this perpetuate cycle, which we are now starting to get out of. Stock bond correlations, at least on the long bond SPY TLT, went positive. I like to see it both on TLT, IEF, and SHY. Like the whole curve goes positive. You know, you can't get it all. It's always going to be perfect every time, but that's the setup that's very bearish. If you get positive short-term correlations across all bond vehicles, across sectors, and a negative one with the dollar, that's the dream that everyone dreams about from a short seller's perspective. So that's kind of the way I look at it.
Yeah, very good example, especially about the dollar. In a short way, I will just add that basically think about chasing and panicking. So it depends on to which direction the market goes, but the sector correlation or bond correlation, yeah, it applies to what Bryan said. But for the offer of a question, just in one sentence, how long can chasing or extreme panicking last? So it depends, because if chasing or panicking is with a correlation 0.7, 0.8, it actually can last quite long. But if correlation goes to 0.95 or above, well, it cannot last long. And that's why the question was about spotting tops and bottoms using that. So first of all, don't try to spot tops and bottoms using only correlation, but that's why extreme values cannot last forever. Yeah, that's what I just wanted to add. But basically, it's chasing and panicking and the magnitude of it. Okay.
Yeah. And one more thing on that, by like also like a key thing with that is you need then runway. And so runway to move in that direction. And the best tool for runway is the long-term MFR range. That's like my key. So if I have a setup right now where I'm looking for correlations to go and stocks to break down, you need then room for it to go. And so that room is like the long-term range in MFR. You can look at the near-term one, but really like if you're trying to, the way I play this, the kind of the way I've situated my style is I go for the big hits. Like I want to be there in size on the big puke days, and make my money over the course of 2 to 3 days. Is kind of the way it's been working for me. And so for that, you need like the big runway, and then you need the correlations high. And so that's another thing to look at. Like I said, like don't just use correlations. Correlations can be very extreme at the end of a sell-off, and that, you know, that's a signal not to be long, because you could keep puking, or it's going to be very volatile and you're going to be buying a stock in like VIX 30s, and that's very hard to do and still sleep at night. But so if you're at the bottom and correlations are high, but there's no runway within MFR ranges, then that negates the signal for correlation. So you have to combine things together for it to make sense.
Yes, agreed. Yeah, if you already have a sell-off of a couple of days and correlation shoot up to whatever 95 and above, that it's not a time to open a short position. If you have a short position, congratulations, but it's definitely not a time to open a new one. So yes. Okay, Raphael, what's next? Bets?
Yeah, somebody, Benjamin said in the comments, Bryan, don't cut that build until we are out of the chop.
Out of the chop, I can do that. Past the chop, like once we start selling, it starts getting a little nasty. I don't have a cool puffy one like Vi. It gets like itchy and gross, and I'm like let it go, shave the neck, you know, a handful of times, then take the beard off, go clean shaven, let it come back. That's kind of the way I go. Keeps it fresh.
Okay, guys.
I like being gross. It helps me trading. Okay.
What about the bet, Raphael? 2-1
Yeah.
last week.
So the bet was what will be the highest VIX value between 2 weeks ago and now. So I guess we went to 21 point something, no? I think the max was 21 point something. I remember we hit something like that. 20 point something or 21 point something. No?
Oh, so the bet was max value, yes?
Yeah, highest VIX
Yeah.
value in the 2 weeks.
21.33.
Okay, so you have Ted is the winner because he went with 22. Yeah,
I win.
Yeah, Bryan, you got run over on the squeeze, found the VIX
I got
spike on the
swooped.
fourth.
It
Okay.
was aggressive. I'll take the honorary win though, because VIX just got spanked today.
Yeah. So yeah, now the question is if we want to do another one. I would go with bonds, bet on bonds, no?
Okay, what exactly?
I don't know, TLT.
TLT.
Yeah, TLT.
TLT.
Yeah.
TLT?
So
Okay, cool.
What kind of bet on TLT you want to do? Trend or a value? Or something else?
Does it break 101 by the time?
How about like 103? I mean, you think 101, right? 102. Okay. I mean, it's in a chop range between 108 and 103.
I want you all to know. I want you all to tell me if bonds are going to puke between now and the next 2 weeks and go back to their March lows. So 101.
No.
101 because it's exactly the short-term range. Yeah, okay, you got it. No.
Yes.
Again, one of those situations where I want to be wrong, but I'll say no. So. Bryan said yes. Okay, Bryan said
Everyone
yes.
that just bought bonds and have made no money because bonds have gone nowhere, about to get stopped out for the 15th time over the last 2 years.
No, Ted, no.
No. I think we chop around some more.
Yeah, it's crazy, right?
I'll go with yes.
There
Okay.
you go, Robby.
All right,
And
Robby, way to go,
do-
man.
Do the S&P too. Do we see a new S&P high?
Oh, come on.
No.
Don't
If
jinx
they
it.
keep selling vol, we're gonna see one.
There's
VIX
no ball to
14.
sell. I guess there is, but
Oh no, come on. I can't take this chop anymore.
we don't see, I say no. We don't see another SP high.
No, I also say no.
So are you saying no higher than what? 41.86, 41.90?
Yeah.
What are you saying?
Do we a new closing high? So the highest closing high was 41.70, it looks like 41.69.
Yep,
So do we
41.70,
close
exactly.
above 41.69 again?
That's like 30 points away.
Yeah, so that's interesting. No, so I don't think so. So
I think
say
so.
no.
I say yes. I'm not bullish, Brian, but I'm saying yes. I think we got to close
Right.
above
Ted's a
41.
big bull over there, man.
Big bull. I shorted at 41.90 for sure.
Yeah, I'll
I-
go with yes as well.
Okay.
Come
So
on, Robby.
so sorry, yes is yes means
new high.
We-
Yes,
okay,
new.
new
New closing
Yes.
high above 41.70.
yeah, I go
Yes,
with yes
closing
too.
high. Yes.
So Ted, then we have Robby and me. And no is only Bry and Vi or
Yeah.
Yes.
okay.
Oh, so
yes,
you, Raphael, you also say that yes.
Yeah, frankly, and I've been pretty bad at this bet, so I'm trying to jinx the people who said yes, just to be
Okay.
so, so yeah, we are good, guys. Quick note: we're gonna have one-on-one with Bryan on the 16th of May. And I want to go through with him about his process and how he basically used MFR to build his own. Because I know a lot of people, we provide a lot of data, right? But we are not directing people to use in a way or in another way, etc. Because everybody is different. Everybody use the tools that we give their own way. But Bryan has built his process magnificently, so we thought it was a good idea maybe to show what could be the starting blocks of building your own and how to do it, etc. So the 16th, we're going to do a live thing, probably Twitter plus YouTube at the same time.
Nice.
Yes, and for those market talks also, we will try to find a way to do YouTube and Twitter Spaces at the same time. So I'm sure first time it will be tricky, and we'll see how it goes. But yeah, it's possible. So yeah, I think it will be more useful if we do it. Basically, audio will go on both YouTube and Twitter Spaces, and video, of course, on YouTube. So yeah. Yeah, so thanks everyone. I hope it was useful. As always, manage your risk well. Thanks everyone for joining. If you have any questions, also feel free to ask. And thanks Ted, Raphael, Bryan, Robby, and see you hopefully in 2 weeks again. Bye everyone.
Bye.
Okay, we're good. I think so.